Today's session, we're just going to cover a little bit of Dow theory, Charles Dow theory, in relationship between Dow Transport Index and the Dow Jones Industrial Average. It's an old, tried and tested system that is mostly about interpreting what's going on in the market as far as the industrials were concerned, is where it came from at least, versus the transports. So the original theory went like this. The industrials were like heavy-duty companies back in the day, and those industrial companies produced products. The products that they produced were then purchased by other businesses or by the consumers, and those purchases were made usually from places throughout the country, right? And that production to get to those places for the consumer or another business to buy had to be transported. And so transportation in the original ways was not by horse and carriage, but we're getting into railroads, ships, and then eventually airplanes. And of course, the components of the transport index, the Dow Transport Index, was basically all of those types of transportation devices and related devices, freight, FedEx, folks like that. Those stocks were then, totally tied into the industrial strength of the Dow Jones. If the industrial stocks were moving, they were making a profit, their production was increasing, you would expect that the transportation stocks would be moving in sync, because what they're doing is they're taking those goods to market. If you had 30 industrial stocks were creating a 5% increase quarter on quarter in production, the industrials themselves were considering that there was definitely demand out there. That being the case, they produced the goods. The transportation had to occur to get them to the marketplace. That meant more goods being transported, so that was good for the transport index. So when they moved in sync, it usually means, or used to mean, a healthy economy. And we'll see later what that means now, because of the way things have changed over the last 20, 30 years and has been accelerating. Because today, the relationship has changed. The relationship between transportation index and the Dow Jones Industrial Average, it's less a confirmation of production and more a confirmation or rejection of economic health, because there's so many stocks now that are in the Dow Jones that don't ship goods by the old transportation methods. They ship goods in the form of digital deliveries, or they ship as far as through the internet. So there's a different relationship going on here. I mean, right at this moment, we're looking at the Dow Jones Industrial Average has just added, well, in fact, it added it in June. It added Alphabet. Well, I think that was a recent one, yeah. There's a possibility that they'll add Nvidia at some point, right? And possibly Amazon. But already you have Salesforce, Visa, Microsoft, and Apple that don't do a great deal of the old transportation movement. So there is definitely a change going on in the Dow Jones, and it's been slowly, it's one of those sort of behemoths that moves slowly, but it is changing and has been changing. Now, likewise, of course, the transportation index has changed somewhat as well. It includes, as I said, railroads, trucking, of course, parcel delivery, airlines, and logistic companies. But also, it's sensitive. There's a way it's sensitive. It's not just a direct relationship between core production and delivery of that production to sites where consumers and other businesses can get a hold of it. There are other sensitivities in transports, and some of this has been around before, like labor costs and the amount of exports or imports from overseas that have an effect on things. But the other thing, of course, is the price of oil, or which reflects in diesel and jet fuel costs, has been having a disproportionate effect recently on the way the transport index moves itself. So there are definitely several different factors involved in here. So there is some changes. But what we're going to look at, let me just move to the next slide here. We just looked at factories produce goods, transportation move them, they move together. when it's healthy. When there's a divergence, it can signal problems. The, the thing is that the divergence isn't necessarily diverging today, and you can see it having happened over the last week or 2 weeks, and you're just waiting for the Dow to catch up with the transports, because that's the way it usually works. It's like the transports would start to decline while the manufacturers were still producing loads of goods and looking great. But they could be producing goods, making a lot of goods, and the transportation is not happening because the demand has disappeared and it hasn't yet reflected in the production. But of course, with that change in the Dow to a delivery systems that are more electronic and digital, that has changed it somewhat, but not completely. It hasn't changed it completely. There is still, and we looked at the last 10 years, there is a case for the divergence between the transportations and the Dow Jones Industrial Average, reflecting a possible unhealthy market. It's just getting the timing right. When, how much of a divergence, and for how long is a likely signal of a change in direction, i.e., Dow will start to move down. So it moves in syncs a lot. We can see that in charts in a moment. To say AI software and financial services are dominating, digital products, little transportation required. Obviously, there's a hidden cost. When I say hidden, the transportation across digital networks requires internet and that sort of infrastructure, delivery, electronics, routers, power, all the sorts of things that power the cloud or any of the data plants that are the big thing these days. So the classic assumptions need updating is really what I put there. Just saying, the transportations, freight demand, consumer spending, right? So these are all tied in together. You can produce stuff, but if the demand's not there, the freight won't turn up. And when I worked in retail management for years, I would be placing my orders from a central warehouse or sometimes direct from the manufacturer. And I'm trying to predict what's going to happen in the next month or so. And if I see my demand has been falling away, I will order less. But of course, the manufacturer itself, it takes time to manufacture its goods. So it's still making the goods. So that trickle down doesn't happen immediately. And that's why the divergence takes some time to spread into the overall health of the market itself. So the transportation measures several other factors in there, including business investment and fuel. Fuel costs is the one thing that can distort what goes on with the transportation index itself, because fuel costs can have a significant effect on the profitability of the transportation stocks, regardless of how much they're shipping. Well, of course, not completely regardless, but it can skew the way the transportation index looks. And that's it. Oil boosts transportation profits, straightforward relationship there. Rising oil compresses the margins. So they can diverge for energy reasons. That can be part of the effect. And we've seen that happen as well. But of course, eventually, rising oil prices, the shipping companies eventually will put their prices up, and that will push its way up to the manufacturer at some point, and also be reflected in the price the consumer pays down the bottom end. So there are definitely competing factors going on here. So what we're going to be looking at is what I call this Dow divergence suite, and I'm going to be building some indicators on this. Dow Jones, its expectations of where we're going. Transportation is economic activity, but bearing in mind that we're shipping a lot of stuff, but it's not a direct relationship because we have still some things happening in the Dow that are unrelated to transportation companies. However, there is still a relationship out there. So we're going to look at that. I won't spend time on these different Dow divergences suite. This is the DDS, as I'm calling it. It's a ratio between the Dow Jones Industrial Average and the transportation index. And we'll later be producing a pressure index, which just shows us how much pressure there is on the industrial average because of how the transports are behaving. So I've looked back over the last 10 years, and I've got a sort of, I'm not going to share, actually I've got a slide in here that I can share this with you as well. But over the last 10 years, the major corrections, and we haven't really had a major bear market, but what we're after is trying to find the corrections. And the last 10 years, let's give you an idea of what this looks like. I think I've got that actually on the next slide here. Yeah, so here's the major divergences between the transportations and the Dow. So the Dow's been going up still, or kind of flat, and the transportation has been going down. This column here indicates when the divergence began, just an approximate area. The transportations, what happened with it, and the outcome and the results. So this is a very, this I just threw the numbers into an AI, and it produced this table here. So these are the major, divergences. There's late 2014, late 2015, 2018, late 2019, 21, 23, 25, 26, which is ongoing now. What happened here? Transportation peaked months before the Dow Jones Industrial Average. There was a correction in August. So see the difference between late 2014 and the August correction. This one here, transportation stayed weak. There was a correction again. This one happened fairly quickly after the sign of the transportation's weakening. This one here, another strong one. So 2018, throughout that period there, they were diverging, but it failed to confirm, i.e. the market itself kind of, it was kind of in this sort of divergence mode, but nothing happened for the entire year until we got to the third quarter. So it wasn't really a failed confirmation, but it was a strong warning. Late 2019, the 2020 crash followed. Again, remember, these are divergences. We know they start, we just don't know when it's going to have an effect. And so you can see it goes further down the list here. So how can we improve what it is that we're seeing here? I mean, we're seeing, obviously, there are divergences, but the timing is kind of all over the place. What's the best way we can make sense of this? So I did some studying back through the different corrections and when the divergence began. And what we discovered is that the larger and the longer the divergence, the more meaningful the warning becomes. And I can't time it exactly, but what we can do is we can get to a stage where we get to these sort of levels here, a historically significant divergence. What does that mean? So when we get to that level, that's a 20% divergence, and we'll go into how we measure that, between the Dow Jones Industrial Average and the transportations themselves. So when that happens, when you get a 20+ percentage divergence between the two, that has historically signaled a change in direction. And it is, and it's really what it is. When looking at the last decade, every correction larger than about 15%, and that's correction of the Dow, was preceded by some form of transportation divergence. But of course, lower than that level, so when there's a correction of 15% or less on the Dow, there isn't so much of it's kind of like a 50-50 shot. So if you get a 10 to 15% correction divergence between the two, it's not as significant. Definitely gets better when you get to 15 to 20%, but 20% or more, that means that something is likely to happen. Something significant is likely to happen. When it's at 20% or more, then you're more than likely to get a 15% correction in the Dow coming up fairly soon. And timing that is a different thing. What we're looking for is when we're in a state where the transportation itself, the transportation index, is in a historically significant divergence. So that's what we try to look at here. And I'm going to just show you some charts in a second that just illustrate how this really works. So it's not this is not, the timing right now is something that we're working on, and how long it goes on, the divergence, and how we measure that before the correction occurs is the final stage in this suite of Dow divergence, or Dow 2.0, as I kind of call it. So let me get out, this is the end of that presentation. I'm just going to pop into some charts for you here. And we'll get rid of that one for the moment. Get to a daily chart. So what we're looking at here, what I've done is I've taken the Dow Jones Industrial Average, which is in the yellow, and you can see here we're going back at the moment to August of 2025 through to the current data. And you can see the regular price action of the Dow 30 itself. In the red overlaid on here is the Dow Jones Transportation Index. So clearly, a healthy market is indicated through Charles Dowell's original theory that's been working pretty well, is that when price action of the Dow and price action of the transports are in approximate sync, and you can see that, say, this period from here, it's in pretty good sync, right? When that's happening, then you're in a healthy market as far as transportations are concerned versus the Dow. They're making goods, they're still delivering goods. And again, we know there's a digital component to this. But it still seems to be working, even though the digital component has grown over the last 10 years and is likely to grow some more. Maybe 10 years from now, it might be different. But what we're still seeing here is a pretty good in sync. I mean, there's a peak here, there's a trough here, right? This is fairly in sync. Things started to look a little strange, obviously, in 2026. We've had problems with prices both across the board of oil. Obviously, it's a serious volatile oil market, but on top of that, there's also inflation fears and price increase pressures in the marketplace itself. So what is a correction and what is not a correction? And we're looking at a daily chart here. In general, some of these analyses that we've been working on have shown that looking even at a weekly chart is probably a better way of analyzing this, because there's a lot of noise in here. We're not looking for something where it's just going to change direction and we get, a 3 or 4% change in the Dow itself due to a divergence prior to that. What the research has shown is that by looking at a longer term average of the difference between these two indexes, gives us a better picture of when there's a major divergence before a fallback correction or a bear market on the Dow Jones itself. I've switched to weekly here because it's much clearer on a weekly when you can see things like this peak here. So the Dow is at the same price as it was. So you're looking here back in late November 24 all the way through to, sort of February 2025. This is a, several months of same price, nothing much happened there. But the transportation has definitely indicated a divergence here. I think we can clearly see that. So when I join, this goes across here, and this is definitely diverged here. And this divergence is a clear example of, the original Dow theory. Transport, they're still producing goods. Those goods are being produced. The delivery is not happening. The demand is falling off. And that's presaged this correction here from the 45,000 level all the way down to the sort of 36. So this is a major move and fits in with our 15% sort of arena of a move to the downside. You notice after this, things move back into sync a little bit here. There's a little bit of a divergence again here, but not very much. I mean, again, this was a more significant divergence than this one was here, because price action here was still back at the highs where it was before. And so there's not a lot of change. When you connect this high and this high here, look at the difference between this and this here. So the Dow's kind of moved back into sync in this area here. So there's not really a divergence. It is hard to see when you look at price charts like this, exactly how clear a divergence is. But we'll see that in a moment. A way for us to measure this more objectively. I'll just take this. So here we are. We're at the current date right now. Remember, this is a weekly charts, right? So what do we know? On a weekly basis, the Dow is way up here, right? I mean, this is our weekly chart. 717, which is to close tomorrow. So until we get tomorrow's data in there, but it's going to look pretty similar to this, right? This thing is plowing on higher. You notice here that the Dow transports is pretty much fairly in sync. In fact, it's almost ahead of the game right here. But there's a little bit of a divergence that's occurring up here. So you already see this sort of small divergence occurring in this area here. This is actually happening now. So on a weekly chart. And again, that is when we saw this back here, this was over a longer period of time. It does take several weeks, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks here, 12 weeks of data, right? It's quite a bit of data there. So sometimes seeing this on a chart, it's hard to tell, what it is that we're seeing here and how we can measure that. And I'll show you after we've looked at a couple more charts what is happening with using an indicator, where we can measure the difference between these two indexes, using some averages to smooth out some of this noise that is hard for us to really discern sometimes. And so again, this is a method of trying to gauge if the transportation's divergence from the Dow still works, regardless of the fact that the oil effect can be dramatic, as we can see in the spikes in the transportation itself. And this, regardless of the fact that the Dow Jones Industrial Average is a different creature from what it used to be. So let me just show you one other chart that I really like at the moment, which is taking the transportation index itself again. And I'll switch this back to daily. And what we'll do is we'll overlay on top of this particular chart the USO, the US oil index. So it's an ETF, tradable. I could do this DJIA, just to show you. Let me pop this up to full screen here. Check this out. I mean, and it's fairly obvious here what happens. It's not always a mirror, but it's quite often is a mirror pattern. When we've looked at inverse SPY versus some of its inverse ETFs, right? You get that mirror line where you could draw a straight line between the two and they're almost a mirror. So like this here is almost a mirror of this. And what are we looking at here? Dow Jones Transportation versus oil. Same here. I mean, you can see here, you get this massive peak in the transportation index when the oil has suddenly collapsed back down here. When I say collapse, in relative terms. And you see it again. I mean, look at the way this is. You're looking at the oil has gone up and up to new highs here. Transportation's been hit. It's a new low here and here, a new recent low. We know that happens because increased oil prices reflect an increased aviation fuel and diesel, increased costs for the transportation companies, squeezing their margins. So we know it has an effect on the value of stocks. It's not necessarily earnings reporting, it's a psychological thing as well. The price of oil goes up dramatically, 5% over 2 days. We know that folks are probably going to dump some of the transportation stocks or airline stocks. If aviation fuel has been at incredible highs in different marketplaces, but that has the same sort of cooling effect upon the underlying stock. So this is a little aside. It's just showing you that there is a definite strong relationship between the two. So you could trade one off against the other if you're short on if you want to go short on the transportation stocks. You do that when the USO spikes up, and it makes perfect sense. So I mean, you see it here. So we look at these peaks here. It doesn't always match perfectly. So this peak here, prices were already fairly depressed, but this came down really, really rapidly. The oil price dropped really rapidly, and this was almost instantly reflected in the change in price of the transportation index itself, which again, you can trade that based upon any of the stocks that are in there. So that oil is kind of a sidebar, I guess I'd call that. I want to get back onto what we've been looking at here. So a couple of things. You remember I was saying that the Dow Jones Industrial Average itself and the transportation index, when it's in sync or roughly in sync, you're in a healthy economy. Everything's lining up properly. When you start to get a divergence, there's definitely some, there's some signs maybe that there's something breaking down. In the textbook Dow Theory, the transportations would also eventually break support level, and that will be followed by the Dow Jones breaking the level itself. And again, as you saw from those examples we looked at, this can happen over several months or a couple of months or less. And so we need to really build something that will allow us to then measure what is going on. So one of the things that we can do is take our expert design studio and build ourselves a momentum, I guess you could call it, or I would call it a divergence momentum indicator. And what I've got going at the moment is the foundations of this. And I want to illustrate how this looks when we apply it to a price chart. So first off, let's backtrack here, and I'll pop into Expert Design Studio here. Let me just blow up the font on this a little bit. Oops, wrong place. Haven't done this for a while. Change the font in here. Just want to make it a little bigger so we can see it better. Okay, so what I did was I'm again using AI to help out here on building this. I used ChatGPT on this one, by the way. I'm usually using Claude, but it was time to see what we could work with another AI, and we looked at taking different moving averages. We built some moving averages: 21, 63, 1, 2, 6, 2, 5, 2. Pretty good periods there. 3 months, 6 months, and a year. And then I started looking at, what do we do here? Well, we can take price action of the Dow and the price action of the transports, right? So I got those two things ready immediately. And what I can do is then make myself a indicator for different moving average periods to try and get the divergence. What's the divergence? A 126, a 63-day Dow divergence. So it's looking over a particular period of time. Fairly simple stuff overall. And right now there are things I'm testing, doing a composite of the different divergence periods to see what happens. But overall, based upon what we've seen in the last 10 years, it does appear that the best place to start from in looking at an indicator like this is the 6-month period. That 6-month period gives us enough indication of what might be, if we get a strong divergence and between the two at the percentage level, 15 to 20%, we know something's coming down the pipeline. That's all it tells you. It doesn't tell you exactly when, but it sure means that you would probably tighten up some of your stocks if you're holding for a shorter to an intermediate term period of time, or you might you might throw out there a leap option on something like one of the like on the DIA, put a put out there, or even a few months out, put that in place, because this is a great thing to have. Eventually, we can just do the DDSR ratio, but initially what I did was I just wanted to plot the difference between the two averages, between the two indexes, and use that to see what it would look like in a chart. Do we get a period where there's a 15% variance between the two? Minus 15, we don't really know what's going to happen there. All we're interested in is what is the difference when the Dow transports are underperforming the Dow Jones itself. So let's I'll show you this first index that we put in there just out of interest for you. This is the first one I did, which is DDS divergence, I call this, which is quite good. I mean, and it's interesting how this works, because let me just I'm going to pop it into the daily for the moment, just so you can see it in daily. So in the daily mode, what you see here is that there's not a lot you can see going on until you get to a period of divergence happening. And when the divergence does happen, you get an extreme levels appearing on the charts themselves. So what we're trying to do here, and I'm still working on refining this, is getting ourselves to a place where the divergence gets to be 15 or below, in this case, minus 15. Once you get down to those levels, once the level's down here, we know the Dow's going up and the transports are going sideways, even on the daily chart, right? So we know this is underperforming the Dow. We know that between 15 and 20% is usually a signal that something's wrong. And this happened here. The first time we got down to sort of 15 in this level here. Let me just put the arrow on here. Yeah, so I can just see this again. The divergence itself, the first time we got down close to that level was really back here. We're down at 15, you see here, 15.05. So there's the 15% divergence on the Dow transports from the Dow Jones Industrial Average. Not easy to see on a price chart straight out, but it's there. So this is the type of thing we're looking for, is to try and key off of the difference between these two. And I will build this into a ratio for us to use. But primarily, what we want to see here is that divergence, is it going to produce results for us? We'll be able to see, when I switch to weekly here, can we see what's going on in the Dow Jones Industrial Average versus the transports? And can we produce a indicator that will help us gauge what step of the market we're in? So this is in test phase at the moment, so you'll have to bear with me on that. I'm not ready to share it until we've tested it a little bit more. But primarily, I just wanted to share with you where this might help us decide, what's likely to happen next. And let's go look back at a couple of the more previous times when the market was really diverging. So give me a second here. So let's go back in 2015 is the first one I had highlighted. So we'll start with 12/31/15. So the divergence here, it actually, the August correction is the one that we're really concerned with here. And the correction really didn't start happening until here's the right. I mean, we'd come back to a recent high, right? We got the same thing happening here on the transportations has definitely got lower. But what's measured, what we want to measure is, do we see this happening beforehand? Look at this, lower highs here. This has not been reflected in the Dow up here. So this is what gave kind of the warning beforehand. What we're going to develop is trying to get an indicator to give us an idea when we get to this sort of stage here, that this is the time when things are going to fall down. The transports are ahead of the curve. They're saying there's something wrong. Meanwhile, the Dow stocks, which included, those digital stocks, not all of them at that time, were just, kind of in a sideways pattern. So that was really one of the best examples, recent examples of the original Dow theory out there. So I think that was a 12% correction, something like that, on the market itself, a small manufacturing correction. The 2018 one, let me see, let's do this one, the 12/31/18. So this was a nearly 20% decline overall on the Dow itself. So this happened in a longer period. It's a couple of months, I would say here. It's not immediately obvious that the decline has begun until we can see, what's happening within the transports themselves. So it was actually it was underperforming the Dow by about 15%. It's just not that clear on this chart here. Let's see if it's on a weekly, it's clearer. No, again, it's a little hard to see, and that's the problem with the visual effect. But it was definitely underperforming the Dow itself, and that gave it gave a warning before this fall that things were likely to go back down. Let me just see. Yeah, 2018. The next one was the 21/22. So let's go to, I'll go back to daily chart. Let's get back in. Let's switch to monthly there. So this is the end of 2022. In this case, we're talking about there was a 15% underperformance going on here. This was where the underperformance was versus this move down. This wasn't a major move. Back over here, there wasn't that much of a divergence in place. You can see it's looking fairly in sync with the Dow itself. However, this was definitely, I mean, this definitely is not in sync with what's going on here. And so you see that happen before this move down from the sort of 34,736 level, took us down to, what is that, 32. Not a huge divergence overall. This one here was a much bigger decline, 20%. But again, once we apply the indicator and we have it completely worked out, we'll see if this divergence indicated this was going to happen ahead of time or not. I think there's one more we're going to look at, which is the 2023. In this case, the transportation was only lagging by, yeah, it was actually, this is a good one because it shows us how important the scale, the size of the divergence is in order for it to work for us, because the transportations have been lagging in 2023 quite seriously behind the Dow at this performance area here. So you see here, right, the Dow transportation's ahead of the curve. That really doesn't mean that anything's happening. But there was nothing in Charles Dow's theory about that. He was looking for the divergence away from where the price action of the Dow was. In this case, there were some divergences going on here, and they're also kind of in sync here, but definitely divergence here. But nothing happened. It wasn't a huge divergence overall. I mean, it wasn't big enough for it to make a difference. We need to have a 15 to 20% divergence between price action of the transports and of the Dow itself. Of course, the third factor that we have, if you're using AIQ, we can factor in a signal. So we know that when we start seeing, and we'll only get this indicator completely ironed out, when we see that it's in its 15% or greater divergence between the two, we can wait for an expert rating on the Dow itself as a confirmation of that. So that's a cool thing for us. I mean, it have to be 95 or greater. As we know right now, of course, we've been sitting, we had that one sell signal back before that move to the downside here. So this sell signal was, let me get rid of all this drawing on here. Oh, I need to be on this one. There we go. And I should delete all of them. Bear with me here, because I drew trend lines on the other chart. There. So if you're going to overlay like this, you draw trend lines when you've got the focus on this side, and then you switch focus to this side. You've got to remember you've got to delete all of them from both sides. So we've had one rating, actually two sell ratings back here, just before that small move to the downside. But we've had no ratings since then. Nothing much has indicated this move back to the upside. However, if there'd been a divergence that was really clear between the transports and the Dow prior to this period, and it could be up to, when we're looking at an average at 6 months, or in this case, even 3 months, the 126 days, gives us, 6 months gives us a really good smoothed outlook of a divergence over a longer period of time. So we'll start to test those to see if those have an effect on predicting when the transportations are indicating that the Dow Industrials are going to fall away. I'm going to look also in testing this, run the transportations against a bigger basket of tickers. So it's worth checking it against the IWM, so the ETF for the Russell 2000. I might do that too, just to see. I don't think, there's been a lot of research on transportation stocks versus bigger, broader market indexes. Would seem like you'd have a lot more production stocks within those indexes, but you also got transportation stocks and software and a whole other bunch of things that might not be related to transport. So it's an interesting area. We'll keep looking at it, but right now, this divergence that's in place on the daily chart is looking to be, close to 10 to 15%. So it's getting close to an area where it might be significant. So it's worth keeping an eye. Put that transportation index on top of the Dow once in a while and just keep an eye on it and see what's going on. Because, yeah, there could be a small correction or there could be a major correction. We won't know until we see this divergence continue a little bit longer. So that's it for today. Mostly, expert rating real quick bit, but it's that change. And I mean, I've just changed the Dow Jones list that we have on our website on the support page. And you can download, the current version, the stocks that are in the list. It's just the list of the stocks. But I like scrolling through those to see what's going on. If you go to the aiqsystems.com or aiqeducation.com, they go to the same location. By the way, we have a new website up there if you haven't seen it already. So you can actually, under the Learn area, I think it is, in Education and Tutorials, there is an area, AIQ list files. These are all updated with the most current components. So they're just lists, except for this one, which is group sectors. But these all have, this Dow 30 has the most current Dow 30 stocks, so you can download any of these lists into your software. And if you don't have the software, well, you can always go and get it. I think most of you do. It's a 30-day try out there for folks to give it a try. So any questions, pop them into the box there. I will have that EDS polished up and made available. It's not going to be today. The recording of this will be available, but I want to test it more. It's early days. I'm not overly satisfied with my helper at ChatGPT. I'm probably going to go back to Claude, because Claude has been absolutely phenomenal in developing expert design studio files with minimal amounts of syntax errors and corrections. So. Yes, Jim. Yeah, there's always so much stuff. It's just that the market, everything's moving in such strange ways these days. It's hard to figure out, but we'll keep working at it. If we can find something, I believe there is, when the divergence is more than 15% between those two, it generally means there will be a correction. We can't measure the size, and we just haven't yet got close to figuring a method other than waiting for our expert rating on the market to occur. So, but again, it all helps. Great, thanks for you folks who turned up today. I know we usually get about 40 people sign up, and they just want to get the recordings. One of these days, I'll just say, if you don't turn up, there's no recording. But really, these things are helpful for all of us in trying to figure out what to do next. Great, folks. I will chat to you again probably next month. We'll have some more interesting things for us to discuss on the marketplace. Have a great day.